What's up, Rise Up Live Free podcast listeners? Brad Gibb here, and I just want to do a quick intro to this podcast episode. This is a replay of a workshop, a very important workshop that Jimmy and I did. So important that we wanted to make it its own podcast episode and make sure everybody heard about it. Jimmy and I, in this episode, we dive deep into our beliefs of why there is a coming market sell-off. It's no surprise, I don't think, to any of our listeners, but what we wanted to do is we want to understand, look, trillions of dollars have been printed recently. Those dollars have to go somewhere. And one of the biggest places that they have gone is to the market. So we talk through our analysis, not the CNN talking head analysis of the market's up, everything is good, you should buy more, but really understanding what's driving the misallocations in the market. And then, of course, as we always do, we bring you some actionable solutions on how to keep yourself safe and protected from that. Continue to align, why you would continue to align, even in today's markets, how the four pillars apply to building financial freedom. So that's what this episode is all about. We do mention once in a while some slides or graphs or diagrams. If you're wanting to see what we're talking about, you can head over to YouTube, and we have a video version of this podcast posted there on our YouTube channel. Just search Cash Flow Tactics, and you'll be able to see all the slides, all the diagrams, everything that we're going through there if you want to go check us out there. Otherwise, dive in and enjoy our analysis of why we believe there is a coming market sell-off. It's the Henry Ford quote of, well, what happens if you lose it all? Well, make it back in half the time. That's true wealth, that confidence that comes. And that's why we spend so much time in Cash Flow Tactics, in the principles. And that's where we spend our time, not in trying to find 100 different ways you can make money. Let's pick 2 or 3 that have worked for the last 200 years so that we can go to work on you instead.
Welcome to the Rise Up Live Free podcast, where we're going to be giving you the exact blueprint to reach financial freedom in 10 years or less, regardless of your age, your income, or your experience.
You see, we believe that 97% of traditional financial advice is dangerous, misleading, or outright wrong. And we're here to empower you on how you can use money and cash flow as a tool to create, build, and live a life you love now, rather than having to wait until you're 65.
If you're ready to take immediate action, join us over at cashflowtactics.com/podcast.
All right, so here we go. We are going to push this into the Facebook group. So if you are in the Facebook group watching it, comment. We'll get back to you. We'll kind of moderate that. Here's kind of the format for what we're going to do. I'm going to rip through some context here for probably 10 minutes. And then we're really going to dive into kind of the meat of the conclusions that we want to come to. And as you guys know, the topic today is a juicy one. This we are informally calling our Freedom Tour 2021. And this came about as Jimmy and I, as we do, we were chatting with each other and venting about stuff that bothers us. And we're like, we should just do this in front of everybody. So we wrote down the 6 or 8 topics that came to mind first and said, sweet, we're going to do this in front of everybody. So you're invited to behind the scenes of our little back and forth. And we're just calling this the Freedom Tour. So we're going to do 6 or 8 of these over the course of the next, kind of as the summer winds down. Last week, we covered what we thought it was going to be end of the eviction moratorium. So it morphed into the continuation of the eviction moratorium, what that meant for real estate investors. We covered that already. This is episode 2, and that is the coming market sell-off. Who's at least slightly to above slightly nervous about where valuations in the markets are right now? We're going to address that, our feelings and thoughts on that. And then the next couple of topics, although they're always subject to change, is going to be how low interest rates are the greatest wealth creation opportunity of the decade. It is not Bitcoin. It is low interest rates. And then also how
Brad, you also said we're going to talk about our feelings about this. And actually, we're not. Because our feelings towards the market are completely irrelevant.
Don't really matter. That's a very good clarification. That is a very good clarification. We're going to give you our analysis of the current situation.
Yeah, I could turn around and talk to this wall, and that would be about as valuable as talking about feelings in this subject.
Jimmy, give us our agency disclaimer. What is agency? What's our agency issue, and what's our disclaimer around this? Are we completely unbiased?
No, we sell things. Generally, it's like reverse agency. Like if you want to believe in what you sell. So we believe in what we sell, but once again, we sell things. So we're going to see the world through a lens of generally things that serve our self-interest and things we sell. But we also have self-interest to be people of integrity and to call it like we see it. But just remember, your risk is that you have long hair and we are barbers, and we will tell everyone they need a haircut. I don't think we do that, but there is an inherent risk because we're human beings.
We will always put that out there. We are here to sell things all the time because we believe that makes your life better. It made our life better. But yes, we have an agency issue because we sell the things that this supports. So we'll just put that out there as our little disclaimer. Kind of the crux of what I want to get into right now. And this, I'll rip through this kind of pretty fast because I think most people get this feeling, but I wanted to give some data to back that up. So what we want to get figured out, really, ultimately, when we're in something like the market, all we're really trying to do is figuring out which way is up. Has anyone ever gone to the beach? Like the first time I ever tried to surf, right? I got out there, missed the first couple of waves, got brave on a big one, and then I got put into the washing machine, right? Has everybody been in that inside a wave before, right? And when you're in the washing machine of a wave like that, all you are trying to do is figure out which way is up, right? Because you know you got to go up, but you're being churned around. With as much as is going on in the world, that's all that we're really looking for in the market, is trying to figure out which way is up and what actions we want to take. And the hard part about this is it's not as straightforward as you might think, okay? We don't know whether this is true economic development or maybe the measuring tool we're using is just getting manipulated and changed, okay? So we're going to go through a little bit of this. So as I look at the market, you guys already know this, but I don't turn on CNBC and look for trends. People say trend is your friend. It's just not the way that I look at it. Okay. So I'm going to share with you guys how I look at the market and what's got me nervous. And then, like I said, we'll talk about what to do with it. But to me, the market only exists to produce earnings. Does that make sense? I mean, it sounds so simple, but companies only exist to produce profits. And then they distribute those profits to shareholders. And that's why you would buy some ownership in one of those companies, is to get earnings. Now, we've been brainwashed for a really long time to believe that there are other factors, but there really isn't. Okay. So if we look at the market in earnings, if I could have drawn a line here, this price to earnings ratio, okay, is a measurement of how much you have to pay to get $1 of earnings out of the stock market. Okay. So the S&P 500 is kind of the aggregate for the stock market. And that this chart is tracking that. So anything above 25 is historically expensive, meaning if I have to pay $25 for $1 of earnings, that's starting to get expensive. There are 3 spikes on this graph that are of interest. And do you know what those time periods are? That was Great Depression. That was right before the 29 sell-off. It got
that was the boom before the Great Depression, the Roaring 20s.
Yep. So this upward line is the Roaring 20s, peaked here at about 33, right? And then
a quick reminder about the Roaring 20s. The intellectual yet idiot experts at the time said financial crashes were a thing of the past. We had become so sophisticated as a society and economy, could never happen again.
That this line was just upwards to the heavens, right? We had it all figured out. They also shut down the patent office because they said everything had been invented and there was no need for it anymore. Do you guys know that? It's kind of cool.
So Brad, we gave the agency disclaimer. Can we also give the, hey, don't listen to people who aren't practitioners disclaimer?
Yes, please give that one.
Yeah, in practice and in theory, there shouldn't be a difference. Unfortunately, in practice, there is. So
there is.
Although we might have an agency issue, we are practitioners and involved in this every day. So I would always listen to us before somebody who had like a PhD behind their name.
And actually, the mix that I want the most out of somebody giving me advice is somebody with an agency issue plus skin in the game. And Jimmy and us, we all have skin in the game. We are doing all of these things, and we're only telling you things that we're doing. So we got skin behind this. So stock market peak right there. It never even reached even almost half of that, right? We had this crash in the 70s, okay? But the next time it got close and then exceeded it, what was this mania bubble right here? .com bubble. Similar feelings to the 29 that we had everything figured out and the economy would never crash. Well, the internet was going to solve everything and we were all just going to be rich because of the internet. Because if it had .com after it, it was going to make you a bunch of money. So it ran past that, peaked at about 45. Okay. And we've never reached that height ever again. And there will be people that'll tell you, oh, we're not even in a bubble. We haven't reached the 99 highs. Well, we blew past a while ago our barrier of 25. You can see anytime it pushes up against 25, we have a long sustained drawdown to get things back in order. We approach 25 here and we push down 25, we push down 25, we push down every single time. So we're now approaching 40. So this is what makes me nervous. But here was a second graph that made me even more nervous. This red line is the price of the market. Do you see the direction it's going? I couldn't get one updated through 2021. I just couldn't find somebody producing that graph, but you see the direction of that, prices. This is what your friendly mutual fund advisor wants to tell you of what you're going to be missing out on if you follow the advice of these guys on the internet with a pyramid as their logo, because the market always goes up. Like that's why we do this, because of this red line. But if we're buying yield, look at the blue line. What direction is the blue line? Yield. And this is measured in dividends on what these companies are paying out. What direction is that going? The opposite way. Does that make anybody like, if I'm giving them money to go generate profits and those are going the other direction, I'm paying more and more for less and less. Got me super nervous. So if I can't trust the dollar because it's all manipulated, here are other ways to measure the S&P. So here's the market priced in ounces of gold. Okay. So this is kind of fun. Before the stock market crashed, it was about 5 ounces of gold to buy. I believe this is the Dow Jones Industrial Average. And then here it took almost 20 ounces and then it crashed and hung around 5. And then it ran up again to 30 ounces and then it crashed back down under 5 and we hung out there. And then we had the bubble push it up in 1999. And then it came down very close to 5 and then we're pushing up again. So this is a way to help us measure it in something that the government can't manipulate, which is now the price of gold. They can't directly because they can't just print more gold like they can money. So this is another graph that's got us, right? We've definitely pushed through the ceiling of about $15 an ounce. And so it's expensive relative to gold. So there's a lot of people saying, sell stocks, buy gold, wait for it to reverse, right? And see how that goes. So that's another indicator. This was a really interesting one that I've never heard anybody else talk about other than a few weird people that I follow. But how do people invest in the stock market? Where do they get the money to invest in the stock market? I mean, when Uncle Sam's not just putting checks in their bank account without asking them. When they're not doing that, where do people get money? They go to work, they earn a paycheck, they pay their taxes, they pay for their mortgage, they pay for their food, and then they have a little bit left over, and then they try to invest that little bit left over. So it comes from their labor, most people. So this is kind of interesting. The average working man or woman had to work about 100 hours to buy the Dow in 1980. So you put in 100 hours of work. If you were able to save all of that, you could buy the Dow. By 1999, you had to work 821 hours. So it was pretty cheap in 1980. You can see how expensive it got in 1999. Then in March of 2009, the average person could buy the Dow for about half as many hours. So we're back to about 350, 400 hours. And today, the average person has to work 1,170 hours to buy a share of the Dow. 1,170 hours. How accessible is the stock market today? Oh, there's always going to be demand. That's not true because people have to go work and have enough capital. I read a fascinating stat. I think it was age 35 and under. They have their net worth for that group of people, age 35 and under, is 5 times less than that same group of people a generation ago. They have 1/5 the wealth. Can those people buy houses and stocks like their parents did to generate their wealth? Not going to be able to, right?
They can rent though.
They can rent, baby. Okay. But we're meant to say that we don't need to look behind this curtain, right? That everything's going up, everything's handled. But here were some fascinating things, again, that I've been keeping my eye on. This one blew me out of the water, right? We know money is cheap, okay? But no one knew it was this cheap. 1 out of 4 companies on the Russell 3000. So if we expand beyond the S&P 500 and go to the 3,000 largest companies, 1 out of 4 do not have enough profits to pay their interest. That means they are borrowing to fund not just operations, but their debt service. 1 out of 4. That means 25% of the market is already broke at 3% interest rates. Okay. The Wilshire 5,000. So if we expand to 5,000, which is basically all publicly traded companies, they are worth 200% of GDP. What does GDP come from? The stuff companies make. So we're saying they're worth 200 times what they actually make. Fun fact, the long-term ratio of that's about 80%. So again, we're about double valued based on what the economy is actually producing. Okay. And this was fascinating. So again, pay no attention to these types of things. This company is an electric car company that put out all these big press releases, all these big videos about what they were doing. Because what's hot right now besides crypto? Electric cars, right? So they put all this stuff out and they got a valuation at $7.5 billion. Okay. So this is what happened. They released this. The founder lied that they'd produce a zero emissions truck. Their lawyers on their annual report, and they lied on their SEC Securities Exchange. They faked all of the, they said that everything was built in-house and it wasn't. They said trucks were coming off the assembly line and showed pictures of it. They weren't. They made a video of the truck as if it could drive, but what they did is they rolled it down a hill and then balanced the video to look flat. They actually did that. Okay. They did
that is
all
awesome,
of those.
by the way.
Pretty genius, right? You got to give it up
if you're gonna be a scumbag, you got to go all the way. And like these guys, they've done it. They've gone all the way. Like not kind of lied, like complete fraud,
all the way out there. And
kudos to them.
And they still got valued at $7.5 billion. We're to the point where nobody cares. No one's looking anymore, right? They're just throwing it all in there. Okay. That was fun. We all know that stuff. Okay. Here's the transition point. I want to stop for a second because what happens is we get caught in mania, right? We get caught in, I have to do this or else fill in the blank of your greatest desire crumbling in front of you, right? And we feel like if we're not doing it, we're going to get left behind. But stop and think for a second. Why do we even invest? Why do we give money to someone else? I came up with 5 very simple reasons. Okay. I tried to make this as simple as I possibly could. If I'm going to give you money, it's either because I can't make more money than you. And so if I give it to you, I'll be better off than me keeping it. Does that make sense? If Elon Musk is better at making money than me, I should give him my money and then I'll do better. Okay. Or maybe I'm just too lazy to work. I don't want to work. So I'll let my money work for me instead. Even if I could do better, I'm lazy. I don't want to, and I want my money to work for me. Everybody following me still? This wasn't what you were thinking. It's not about rates of return, you guys. It's not about net worth. It's not about valuations. This is our end outcome, right? Number 3 would be I value my own time more than the difference between what I could do if I actively worked and giving my money to somebody else. I'd rather it come in passively and then take my time and go do something else. I want to own my time. That makes sense? So I would take a pay cut to not have to work. Number 4 might be I'm still working, but I have more capital than I can work. And so I'll give that capital to somebody else, even though I'm still working and deploying everything that I can. And then last is I'm either too old or too sick to work. And so my capital has to work on my behalf. This is the idea of retirement. Does that make sense? Can anybody think of other reasons we'd invest? I mean, that's it, right? So if we're trying to think of putting our money in the stock market to accomplish one of these things, okay, now we have to figure out what is investing? Like, what is the definition of investing? So we got to figure out what investing is. So one of the problems is we've lost sight of why we're investing. We just want things to go up in value. And we're not translating that into, well, wait a minute, what if I applied myself or what's coming? Okay. Second, Jimmy, when people use the word investing, are they really talking about investing?
No, they really mean speculating. The only thing they have in common is in both transactions, you depart with capital.
And in all of these scenarios, we depart with capital. So we've taken, and this is super clever for Wall Street, incredibly, they've even gone beyond, and they don't even say, because think about this. If your 401k advisor, when he comes to you and says, save money in your 401k, you feel secure. You feel like that blanket around you, right? When he says, invest in your 401k, your ego takes over, right? And you're excited to go tell your brother-in-law how big a deal you are. But what if he came to you and said, hey, we should all speculate in our 401k? How would that go over? Do you think as many people would be in 401ks? Yeah, probably not, right? Okay. So the key here, I just highlighted a couple here. Investing starts with the expectation of safety of principal and a return in the forms of dividend, interest, or rent. Sounds like cash flow. That's really interesting, right? Seems like it leads with security, safety, protection, plus cash flow. Okay. Trading, we're going to skip over, but speculating is buying for resale with the expectation of capital appreciation. Things go up in value. What does that sound like? Stock market, right? So now as we look at why we're investing and whether we're investing or not, it makes sense why we would want a safety of principal and cash flow rather than a bet that things are going to go up. Okay. And at the end of the day, this is most people's plan. You guys ever watch You guys watched the Batman movie, right?
This was one of my favorite movies.
One who loved the Joker, right? But this is how we're all operating. There is no plan. The plan is that some other bigger fool comes in behind us and they might buy it for what it's currently valued at. That's the only way it works, is if there's a bigger fool behind us. That's what we're trying to avoid. But Jimmy, isn't real estate overvalued too?
I don't know. Maybe.
Well, it's all relative. So let's look at some relative values and then we'll get into the fun part. Okay. Again, back to the PE ratios, S&P's at 39.9. Okay. And by the way, you only get that return at the very end, the day that you sell. Keep that in mind. You get zero until you sell. Okay. Apple is interesting. They've kind of come down recently. They're at 35.6. So you have to pay $35.60 for every dollar of Apple's earnings. Amazon, you pay $77.86. Here's the crazy one, guys. Everybody loves Tesla. Let's get on the Tesla bandwagon. You are currently paying $1,102.61 for every dollar of Tesla's earnings. And guys, they're asking you to ignore the fact that 1/3 of their profits are coming from selling tax breaks. They're not even selling real products. A third of their profit.
Yeah, Brad, I think you're paying for entertainment when you buy Tesla.
You are.
And it's kind of cool.
And to have a chip on your shoulder and talk to your brother-in-law at the family reunion about how smart of an investor you are, how forward-thinking you are. Yes. $1,100 per dollar of earnings, not to mention that a third of that isn't even, it's just selling government-made regulation. Okay. But here's the kicker. The historical average is 12. 12. So the entire market,
S&P
from 1900 to now,
okay,
the historical average is 12.
Adjusted for inflation?
Yeah.
Really?
It's low. That's what's crazy, right? And what people forget is there was like a 40-year time period from the end of the crash to the run-up of the dot-com bubble that the market was going up, but earnings were going up with it. That's why the inflation stuff doesn't matter here, Jimmy, because this isn't just raw prices. This is prices adjusted against the earnings of the companies.
Oh, yeah, because the earnings should be inflated too.
Are coming along with it. So investors rationally said, I think the company I'm giving money to should probably have that little thing known as profits coming behind it.
People used to invest for dividends back in the day.
Yep. And then they'd say, oh, we're not going to give you dividend because we're going to go build this new factory. We're going to take that and it's going to give it to us in the future, right? And now they just say, we're going to the moon and you should be cool and come with us and give us your money. And dude, Tesla has had up until the last 3 quarters had never generated a profit ever. And yet they were still valued at these types of things. So it's just, again, it's just craziness. Okay. So here's some things. This was fascinating when I watched somebody break this down. The current market cap of Tesla is $660 billion. Their PE ratio is $356. At its current profit per car, Tesla would have to sell 25 million cars to bring their PE ratios back to the historical average of 12. Does that make sense to everybody? So even if you just said, hey, I got in early and it went up and earnings will catch up, they'd have to sell 25 million cars. Well, the entire world auto market is about 80 million cars. So that means that number is wrong. 1 out of every 3 or 4 cars sold would have to be a Tesla for it to justify that valuation. How does that make you feel about owning Tesla stock? Or that there's still lots of gain left?
If I bought stock and I bought Tesla, I would still feel cool.
I would still feel cool. Okay.
It would feel as good to me as 100 Instagram likes.
There you go. So here's the turn. Okay. Here's why I don't think real estate's overvalued. If we run real estate through the same measurements we have in the stock market, and all the math is here, you guys can look at it, but the equivalent earnings per share for real estate today, $120,000 house that only rents for $1,000. So we're at like 120x rent. So that's even overpaying. Our earnings per share is about $16. So you're paying $16 when you pay cash for $1 of earnings inside a rental real estate. Do you see why real estate can be so powerful? Still, people don't understand this because they don't talk about their 3-bedroom, 2-bath house on the outskirts of Missouri in their family Thanksgiving. Okay.
Go through those numbers one more time, please.
Yep. So back up. So at 1,000 months,
no yawning on mastermind calls.
Oh, buddy, at $1,000 rent, take out 40% for operational expenses. Okay. That leaves you $600 a month in earnings. Yes.
Okay. I'm following that.
Okay. Multiply that by 12. You get $7,200 a year in earnings. Yes.
Yes.
How much did we have to pay for those earnings? In this case, I said you paid $120,000 for the house. So I paid $120,000, got $7,200 in earnings. If you divide those two numbers, it comes out to $16. And you pay $120,000 divided by $7,200 is $1,667. So I'm paying $16 for every dollar of future earnings in the real estate that I'm buying when I pay cash. Okay. If I go to private lending, Jimmy, you'll think this is interesting. I can give up $100,000 to get $8,000 back, right?
Yeah.
So if we do that math, the earnings per share equivalent inside of private lending is $12.50.
Nice.
Haven't we been seeing that if you're going for immediate cash flow and that's all you care about, lend your money, right? We got to build the cash flow over time. Okay. But do you have to pay $120,000 to get a house?
You do not.
So if I get my welfare check and I put $30,000, here's how it changes. My earnings drop by the interest on the loan because now I'm adding that as an expense. That's about $300 a month. So my earnings go to $300. But then if I just add 3% inflation to the equation, that's about $300 a month. So my earnings before even tax considerations stay at about $600, but I only had to invest $30,000. That means I only have to pay $4.16 for every dollar in earnings I'm able to garnish out of a rental property. Oh, but Brad, I can get rich in the stock market. No, you just have to wait a really long time. This is why we can be financially free in 10 years or less. We pay less for every dollar of earnings. That's how you get rich, is you pay less for the future investment return. You don't overpay. $4 versus $40 in the S&P versus $1,100 in Tesla. It's going to take a lot of change to get me excited about investing in Tesla. Oh, and by the way, key point, my earnings in real estate are paid in cash, right? Or at least half of it is, where for the stock market, I have to wait until I sell and my exit strategy is another joker bigger than me. Cool. All right. Here's the end game. Has anybody done this on a bike before? Right? Remember as a kid, you get going down the hill too fast, gets wobbly and wobblier, and you're never going to recover, right? Von Mises saw this a long time ago. He said there's no means of avoiding the final collapse of a boom brought about by credit expansion. We are somewhere in this stage of credit expansion. Wheels are getting wobbly, right? We're starting to see it. They're correcting, but the correction's got to get bigger and bigger, okay? So there's no avoiding the wobble that we're in. But here's kind of some interesting stuff. In 2000 to 2007, to reinflate the stock market bubble, it took about 15 trillion in debt, okay? And then worldwide, debt doubled. In the US, to come after the real estate bubble, it took 3.6 trillion. Wait, no, what? How are my numbers off? No, 3.6 plus 7 plus, oh, my numbers are off. I copied and pasted things wrong. Like I always, no, last financial crisis since 2008. Oh, Federal Reserve's paper creation exceeded GDP growth by 15 times. So last time it doubled, debt doubled last time. This time it was a 15x increase because every adjustment requires a bigger adjustment the other direction to catch yourself. Does that make sense?
Yep.
Okay. And that's just how debt works. Ray Dalio talked about this. We taught this last year to you guys. We can overproduce for a little while, but then we have to come back, right? Money must be drawn from the present into the future to pay for the debt. The more debt, the slower the growth. And we're reaching, I mean, at some point that debt's going to bring us back across this line, okay? But Jimmy, here's the turn. And this is where we want some of your guys to
Dalio's recommendations.
Yeah, we could go through that.
Yeah, I mean, I love this. Before everybody wants to start panicking and getting their food storage and getting in their bunker, overall, human productivity continues to rise and society gets wealthier. So booms and crashes are just booms and crashes. Nothing to get that excited about. As long as you continue to work, continue to produce.
And the big
and
thing
protect yourself.
Yes. Keep going.
That's it.
Okay. Yep. And bubbles pop when debt can't be serviced. So the hard thing is are we in one of these little ones or are we in the big turn? Right? That's what we got to try to get our head around. Okay. And paying attention to debt levels and money production is part of that. Here's the big takeaway. Jimmy, this is where I want you to jump in a lot. So Thomas Jefferson saw the bigger danger a long time ago. Okay. This is 1792. He said a system contrived in the Treasury Department. This is why he hated Hamilton, right? A system contrived in the Treasury Department for deluging the states with paper money instead of gold and silver, for withdrawing our citizens from the pursuits of commerce, manufactures, building, and other branches of useful industry, to occupy themselves and their capitals in a species of gambling. Now, I know they talk a little bit funny back in the 1700s, but what he was worried about is as inflationary pressures drive asset prices up, people will stop commerce, manufacturing, building, and doing useful industrial things. And instead, they will occupy themselves. They'll spend all their time gambling on what the assets that are going up.
You need to replace that word with speculating.
Speculating, sure. Speculating.
You want to hear a history fun fact? Okay, so this legitimately happened though. So when, we did the Constitution and then Hamilton, for lots of reasons, the first bank of the United States, right? Mm-hmm. A big part of Manhattan shut down. And this is where Jefferson got this idea. A big part of New York shut down because everybody started speculating in bank stocks. Like legitimately historical fact that happened. And so what he's concerned about is that if their speculation is rampant, everyone will spend their time speculating instead of working. That also means for modern day times, everybody will spend their time drawn to CNBC, yeah, instead of working. The chatter around the water cooler is about speculating. It's not about how can we get more productive what we're currently doing? So even though Jefferson died bankrupt, even though he was a horrible businessman, even though he couldn't turn a profit if it hit him in the head, this is one thing he got right.
He got this thing right. And that's what I'm more worried about here is because is it easy to get a college degree? No, it takes you applying yourself. Is it easy to be good at your job? No. Is it easy to start a business? No. But if it's easy to go online and pick a random cryptocurrency and have it 10, 15, 20x your wealth, what are you going to do? You're going to sit around in your dorm room and play video games and speculate that everything is going to be taken care of via cryptocurrency or whatever speculative thing. And we're not going to get degrees. We're not going to become smarter. We're not going to hone our craft. We're not going to start businesses. We're not actually going to become productive. This is the big danger of the stock market bubble. This is the big danger of the cryptocurrency. This is the big danger of the inflationary pressures. This is where it borders to me on immoral, because we sell out people instead of saying, you know what the American dream is? It's not investing your 401k and retire early. It's work really, 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 really hard and then work a little bit more, and you can actually have a good life. But if we sell it short with, we can just print our way through to prosperity, that's the bigger danger. And so what we
print our way to prosperity, but speculate our way to prosperity instead of a viable trade or creating value. And like, there's only 24 hours in a day. There's only so many places you can force your mental energy.
And so what we're seeing, and the reason we wanted to bring this up, and you guys know it, we're preaching to the choir, but for those that don't hang out with us quite as closely is what we're seeing is we made our logo this way on purpose. What's at the bottom of the logo, Jimmy?
Skill sets, mindsets, networks.
Skill sets, mindsets, networks. Okay. But what we see happening is the opposite. People are taking their money, speculating with it, and saying, I don't need to get better. I don't need to expand my mindset, skill set, networks. And the base of their pyramid's upside down. Who met us? And after explaining core 4 pillars wealth pyramid, you're like, crap, my wealth pyramid's upside down.
And then Brad, here's my attitude toward the stock market is like, I think the stock market's phenomenal. I think it adds liquidity to the market. I think it's great. But the motto of the stock market used to be, don't let the pikers in. And what a piker is a poor person. Pikers were the lowest level soldiers in the Middle Ages, and they held pikes, which are essentially really bad spears. But so you used to not let poor people in because it wasn't a game to play. And so the stock market wasn't about like 20 times returns. It was about, you're already wealthy. Let's beat inflation and let's continue to grow our wealth at a reasonable rate, probably around 5 to 6%. And I think if you want to do that, if you're already wealthy and you want to make 5 to 6% in the stock market, I think it affords that all day long. There's a lot of really smart, intelligent people doing that. But if you're trying to become wealthy, no way, no how.
To create it, right? And
Correct.
That's why it sits at the top, is it starts with us and our ability to produce. Then it starts with protecting what we have, then the level of wealth creation, then it can be wealth preservation or speculation or fun or whatever else you want to do.
So when people say the stock market is a great wealth creator, they're correct. It is a good place to put money if you're already wealthy.
Well, see, I'd fine tune that, Jimmy, and say it's a great preserver of wealth, but it's like saying education creates prosperity, or is it the other way around?
Yeah.
Right. We've just created a lot of wealth in the United States.
It was not designed to be a casino. It was not designed. It only started being a casino when people were trying to force yield. So forcing yield means you're willing to accept more risk and try to chase more return. And then you're trying to squeeze blood out of a turnip. It doesn't make sense.
And I think with the downward pressure on the middle class through inflation and all of those pressures, the more desperate you get, the more you chase something like that. And to me, it's a sign of we're desperately trying to chase wealth as opposed to starting at the bottom, investing in ourselves, focusing on what we can control and actually building the wealth, right? And so at Cash Flow Tactics, people are like, what do you guys do? Do you insurance or real estate or what? It's like, really, like step one in what we do is we've got to flip your pyramid, right? This is when people are like, oh, that's just so like, everyone's like, this is all in. This is such a big deal. It's really not, right? but most people are so out of whack that the only thing we can do is what looks extreme to turn that pyramid around. Okay. That becomes what we do for people, step one. Okay. Then after we've got that going, this is the real game. Jimmy, walk us through real quick your version of the hero's journey and why this is really the end game of what we're doing at Cashflow Tactics.
Well, the only way you're going to create more value is to learn to create more value. The only way you're going to learn to create more value is to acknowledge that you're deficient in some way and that you're going to have to grow. And then the only way to grow is to hear a call to adventure, figure out where you want to go, cross that threshold into the unknown, go to the abyss, get beat up for a while, learn the lessons you want to learn, have to learn to create more value, come out of the abyss with the boon, return with the boon, and repeat the process over and over and over again. And if you look at anybody you admire, you look at anybody living a dream life, that's what they've done.
Every wealthy person has done that. So I want to connect a couple ideas here for you.
And
guys.
It doesn't have to be even wealthy people that you admire.
Yeah,
anybody who's done anything worth admiring had to figure it out, had to go into the unknown.
We admire it because of this, right? And so what we're looking at here, but here's what gets in the way, back to that idea of what Jefferson was worried about, right? There is no hero's journey when we just speculate on capital appreciation, right? And if my money isn't accessible to me, if it's not in vehicles like the vault, in assets that we have the core four pillars like real estate or our own business, we're actually prevented from this. And Jimmy, do you spend very much time worrying about the stock market?
The first I thought about it was when you said we're going to do this talk today.
Yep. Do you worry very much about how much money Biden prints?
It concerns me at a societal level, yes.
But you're not freaking out.
No, I'm just buying and selling more real estate and holding on to more real estate as a hedge. I don't worry about it. I hedge it.
You leverage it. Yep. You understand the system and leverage the system.
Yeah.
But that's because you've gone through a couple of these hero journeys. Yes.
Yeah. I mean,
several.
They put an eviction moratorium on. So what do? I buy more houses with guaranteed rent.
We just leverage this. We just play the game.
Yeah. I don't get angry about it. That's the key thing I had to get over, not getting angry about it.
So true wealth, you guys, this is kind of, again, the crescendo here. True wealth isn't valuations, isn't picking the right stock, isn't life-changing money from once in a lifetime opportunity. True wealth is being empowered through the hero's journey, right? It's the Henry Ford quote of, well, what happens if you lose it all? Well, I'll make it back in half the time. That's true wealth, that confidence that comes. And that's why we spend so much time in Cashflow Tactics, in the principles. And that's where we spend our time, not in trying to find 100 different ways you can make money. Let's pick 2 or 3 that have worked for the last 200 years so that we can go to work on you instead. That makes sense?
Can I speak to one more danger of speculating?
Yep.
Sure. There's the danger Jefferson talked about of but there's libraries of books written about the emotional aspect it takes to be a speculator. Like what you have to be able to do emotionally to disconnect to actually be a good speculator. The reason I don't do it is because I do not have the emotional fortitude to go through to do it. And so it is can be extremely dangerous to a mindset.
And there's volumes of books written on what happens to you when you gamble and speculate and win, right? And so there are lots of people that, and I'm one of them, I just refuse to gamble. I refuse to speculate because I don't want that conditioning, right? I want the dopamine hit to come from working hard and accomplishing something, not getting something easy, right?
Yep.
So, Jimmy, what do you got for us? Do you want to wrap us up?
Thank you for bringing this to our attention. I did not know that math. So as you guys know, I'm not a detail guy. Brad's the detail guy. Brad's the math guy. My mind operates in very simple principles. Don't start at the tip of the pyramid, at the top of the pyramid. And it's like, I'm still hammering away at it's the third level of buying cash flowing assets. And I I would say nothing has been more frustrating and nothing has forced me to grow. Probably Ranger School forced me to grow more than buying and selling real estate. But I am enjoying the journey.
Awesome, dude. We didn't get a lot of comments, so I want to pull some interaction. How many people on here? We got 38, 39 people still on here. How many of you guys are not in our mastermind, not in the game, not having us coach you through this? I see a lot of familiar faces, but I see a fair amount of other ones. What questions, takeaways, insights that we're doing this kind of on the free side so we can get some of this information out to you guys? What have been some of your guys' takeaways, thoughts on this? Anybody want to be brave for me? Was this a big waste of everybody's time and we shouldn't do anymore?
Brad, it was really helpful to see the graphs of the overinflated price to earnings ratios and how everything really relates, because there's a lot of talk about the market and stuff being overinflated now, but the visual aspects of it was really helpful to put it together and see how it compares where we are now with where we were in other similarly overinflated scenarios or timeframes, specifically the 20s and then the .com bubble.
Good. And for me, I'm the kind of person that needs some sort of validation to what's going in I got to talk with somebody and be like, okay, I'm not crazy. Right. So hopefully that helped everybody be like, yeah, you're not crazy.
Well, it's one thing to look at it and say like, okay, the S&Ps are trading over 4,000 now, but that doesn't, without being able to relate that to something else, it's just a nebulous number that's out there. Yep. So like, okay, now it's trading over 5,000. So what does that actually mean?
Mm-hmm. Yeah. We don't have to feel like we have to catch that bandwagon either. We can just let it go. You guys, all the suckers can jump on it. And I'm going this way.
John Wilson had a comment here. I did the initial call 6 months ago. Would like to talk to somebody about next steps. So John, what you're going to want to do is schedule a call with Sean. Braden, can you throw the link in Sean's calendar? Get on with our premier cash flow coach, Sean Beckman.
While he pulls that out, Emily asked, how safe is money in a vault? The reason we lean on the safety of the vault is, so I'm actually going out, I'm leaving tomorrow on a trip that the insurance company providers put together for top producers. Most everybody else hangs out at the beach. I hunt down the investment advisors and the actuaries, and we geek out in the back of the room. So I'm going to be doing that this coming week. So I'm actually excited about that. But in that process, as I've talked to them about how they invest, it's actually amazing. They follow the same processes that we're talking about here. So they invest in companies through earnings. They look at the bonds that they buy are focused and driven off all of that. And that's why they don't get crazy and out of whack. So if we look historically, this is the couple cool facts about insurance companies. A, they've never not paid a death benefit that has been legitimately claimed ever. So this is like going back to the 1700s. They've never not paid a claim. They've never not met their guarantees. So they give you guarantees, but they've never not met those guarantees. And third, they've never not paid a dividend, at least the companies that we work with and operate with. So that's the data we're looking at, that why we're choosing them to secure our capital before going and making the investments there. So that is
the quick answer to that is Great Depression, tech boom, 2008. You can make an argument that the life insurance company's liquidity held kind of saved the economy in 2008. So very confident in disastrous situations. Capital in the vault, solid.
They bailed them out. So we play those types of games. Jimmy, you got anything to close out on?
I am going to go buy a Humvee this weekend. Not like a Hummer, like a Humvee, like something I used to actually ride in. I don't know if that's relevant whatsoever, but it's Friday.
That is super relevant. I want to see pics of it, dude. That makes me super jealous. Awesome. All right, guys, that's it. I'm going to go enjoy my Friday afternoon. Jimmy, going to go buy a Hummer. Thanks for your guys' time, and we'll catch you guys on the next episode.
Hey, guys.
Peace out. I hope you enjoyed that last episode, and thanks so much for listening to the Rise Up Live Free podcast.
Do you have a question that you'd like us to answer raw and uncut on this podcast? All you need to do is head over to the Apple Podcast and do 3 simple things. Number 1, leave a rating and review telling us what you think of the podcast. Number 2, In that review, ask anything you want related to your path to becoming financially free.
And third, if you want to shout out, leave your Instagram handle or name. That's all. Then listen in to hear your questions answered live, raw, and uncut.
Join us next time on the Rise Up, Live Free podcast.